Hi, Barbara Freeberg here, former portfolio manager, university investments instructor, here to talk to you about lazy investing. Now, some people like to spend a lot of time researching investments, studying the stock market, the financial markets, buying and selling securities and funds. If that's not you, you're in the right place. Lazy investing is a strategy to invest in a smart way to get good market matching investment performance over the long term without doing a ton of work. It is proven, these strategies I'm going to talk about have been proven by a lot of research by very smart people from Vanguard and major universities that suggest following a simple index fund, passively managed investment approach will yield you better returns than most actively managed funds and active fund managers. So let's get started. The best lazy portfolio is one that is set up in line with your risk tolerance, how much risk you can stand, rebalanced regularly, and invested in a diversified mix of stock and bond funds. We'll go through today a little bit about my lazy portfolio story. What is a lazy portfolio? Performance, show you some examples, and finally, give you a strategy that you can use to set up your own lazy investment portfolio. Many decades ago, I was a stock picker. I was a portfolio manager for a real estate holding company, and I believed in fundamental analysis. I would go through the the ratios, the financial statements, all of the information about individual companies. And then I would determine if they had good growth prospects and if they were fairly valued and had an opportunity to grow and compound and therefore make me money. Now, I did pretty well with this approach. And so when I went and I started my MBA, my first day in my MBA investment class, the question was asked by the professor, how many of you think you can beat the markets with your investing? Of course, my hand shot up. I'm a portfolio manager. Of course, I can beat the markets. What I later found out and what catapulted my investing strategy from one of a stock picker to a lazy investor was the research. And I mean, not one article or two articles, but across the board, many different well-regarded university faculty, Vanguard, the company, research showed that over the long term, it is very hard for individual investors, individually managed funds, actively managed funds to beat the market average. Now, what is an average? Well, we've all heard about the S&P 500. That's frequently used as a benchmark for the overall US stock market and just follows the top 500 companies. And typically, the return of the US stock market over the past 100 years has ranged from 9 to 10% annualized. That means if you take that whole period and you annualize it out to a return for each year, the average is 9 or 10%. But just so you don't think you're going to get that return every year, understand that within each year, and we all know from 2022, the market can really have some nice tumbles. We lost over 20% in 2022. So the key to lazy investing, and typically, depending upon your risk tolerance or the amount of volatility you can stand, which is the ups and downs of the stock market, you will invest in a combination of stock ETFs, exchange traded funds or mutual funds, and bond funds. And greater amounts of investing in bond funds will lead to typically lower returns, but less volatility in the price of your portfolio. If you're younger, more aggressive, you'll probably want to own a greater allotment to stock investments because they have higher returns over the long term, but they are also more volatile. So that is what is a lazy portfolio. Here's some of the market indices that can be used in funds in a lazy portfolio. We talked about the S&P 500. The Russell 3000 is an index that tracks the 3,000 largest U.S. traded stocks. NASDAQ, we all know, are the tech stocks that are a little more volatile but tend to have higher returns. And then the U.S. Aggregate Bond Index is just a market index that follows fixed income securities. Okay, so why do you want a lazy portfolio? Low management fees. Did you know that every dime of your money that goes into a management fee is not going into the investment markets? So low fees automatically will give you higher returns. You'll get good market matching returns. Stock market, as I just said, average 9 to 10%. But you got to commit. You might as well just turn off this video if you're not going to invest for 7 to 10 years, because short-term investors should not be in the financial stock and bond markets. They're too volatile. You should be in cash investments. Number 3, why you want a lazy portfolio. It is super easy to maintain. You can maintain it yourself, or you can use a no or low fee platform that will kind of rebalance your investments on your own. So how do you figure out your performance? Here's a typical Vanguard lazy portfolio, and this one has 6 different asset classes. Now, you don't need this many asset classes to have a lazy portfolio. We're going to show you that you can have as few as 2, 3, or 4 asset classes and still get a very nicely diversified portfolio. This example, this is not a real return for a recent year, but it is a real return for a prior year. And this portfolio has a total stock market fund invested in 30%. A developed markets, which is an international fund, emerging markets, which are those smaller, newer companies internationally, long-term treasury bonds, inflation-protected bonds, and real estate companies. There is one asset class that I just noticed is kind of missing from this portfolio. You probably want some corporate bonds too. But anyway, that's for another conversation. So we selected a percentage, which is our asset allocation. We had 30% in the US stock market, then we had 20 in the international, and then we had the remaining 50% in bond categories. Now, a 50% stock and a 50% bond portfolio is very conservative. And unless you're, 60 years or older, you probably want a greater allocation to your stock market investments. But if we take the returns of each of these funds over 1 year, we divide them by the percent invested, and you get, in this 1 year, this diversified portfolio gave you 11.7% return. You can have what is a relatively diversified lazy portfolio, or you can go simple, simple, simple. And I'm not going to say which is better, which has the better returns, because when you invest in one mutual or exchange traded fund, you're automatically diversified, because that fund will own hundreds or thousands of individual stocks or bonds. The simplest, laziest portfolio that we can put out there is to put 60% in an all-world stock index fund or ETF. And you can go with a Vanguard, or you can go with an iShares or Schwab or any of the others. And, this is the stock market fund. And then you can go with a total US bond market fund. Now, I don't invest in international bonds. That's not to say they're bad or they're good. But you can if you want to. You can diversify any way you want, but just understand that you don't need a lot of funds to become really, really diversified. Now, Bernstein is a very, very wise investment writer, and he recommends a 4-fund lazy portfolio with the US bond market fund, Standard & Poor's 500 index fund. He likes a small cap index fund. And the reason for that is historically, and I don't mean over 10 or 20 years, I mean over decades and decades, small cap companies have outperformed, but you got to be really patient. And then he suggests a European stock index fund. Again, I'm just giving you choices so you can decide yourself which way you want to go. Here is the big secret. This is our family's current lazy portfolio. We tweak it periodically. I'm not saying this is great. It certainly has had its disappointments. And frankly, if you're really diversified, expect that you will be diversified. You will be disappointed with one sector of your portfolio at any one time, because that's the purpose. The strong returns offset the asset classes with negative returns. So unless you have a super strong stomach and want to go for the highest potential returns, you will have some bond type investments added to an all stock portfolio. Because historically, although stocks have returned the greatest amount over years, they have also had the most volatility, sometimes within a year falling 20, 30, or 40%. So, again, this is not a recommendation. It's just kind of showing you, opening up my investment closet so you can see what I'm invested in. Our family has 30% in the US stock market. We have a mid cap value and a small cap value fund because at heart, I am a value investor, which means value companies typically find stocks that are trading at lower than what the market thinks is what is their true intrinsic value. And the reason I like those is because they have a potential for very strong growth when their value catches up with their true market value. Now, I'm going to confess that over the past 10, 20 years, the value type of investing has been out of favor and hasn't done very well. That's not always been the case, and hopefully that will not be the case in the future. And recently, value has come up to meet and surpass in some periods that of growth investing. Then we have a little bit of real estate, a little bit of international, 18%. Now we have 22% in bonds and 12% in cash equivalents. That's a lot of fixed income, but we're looking at a portfolio that is best for someone who is older. And we are looking predominantly at capital preservation and growth as a second. So how can you set up your own lazy portfolio? Full disclosure, I also have an account at M1 Finance, which gives you pre-made lazy portfolios. I love these because you can go in and you've already got your lazy portfolio set up. They have 15 different types, arranged all according to your risk level. So for example, at M1 Finance, let's see if we can actually read this. The general investing is a diversified portfolio, and they call them pies, which includes stock and bond funds. And you can choose one for aggressive or conservative and a couple of steps in between. Aggressive, as we've said, has more stocks. Conservative has more bonds. They have retirement portfolios, socially responsible, those for people that are looking for income. Those that want a little more pizzazz, the chance to possibly outperform the markets, hedge fund portfolios, and then a simple two fund, just stocks and bonds. The lazy investor might, if they wanted to go to M1 Finance, might consider just a general investing plan for retirement and just stocks and bonds. And I bring up M1 Finance because it is a very easy way to craft a lazy portfolio. And you can choose from pre-made portfolios, like the lazy ones I've shown you. You can also pick and choose your own stocks and ETFs. They also have themed stock collections. And the cool thing about M1 Finance that I like is that there are no commissions, there are no trading fees, there are no management fees, and they will rebalance for you with just one click. So again, I said I do have an account with M1. It is financed, and you'll see in another video, I'll delve a little bit into my M1 portfolio. And just as full disclosure, if you do sign up for M1 with the link listed below, our company will get a small commission that goes towards funding this channel. So obviously you don't have to use M1 Finance. You can set up your own lazy portfolio and rebalance it on your own. Now here's a sample of the M1 General Investing Lazy Portfolio, and it's not too different. And let's see if I can move this over a little. Probably not. Okay, so you've got 27% bonds, 23% S&P 500, developed markets, small caps, international bonds, emerging markets, real estate, and mid-cap. This is a nicely diversified, lazy portfolio. You can buy it in a click at M1, no fee investing. They'll rebalance it for you. This is for a moderately aggressive investor because you determine that by looking at the percent of stock investments, 23%, 21%, 14%, all in stock investments. And that comes out to 20, 40, 50, about 60% stocks. Oh, yeah, 60% we had in this extra mid cap. So, what's the takeaway? There's no best investment portfolio for anyone. But if you want to outperform 70 to 80% of active stock pickers and funds, if you want to set up your investments to not take over your life, but to give you time to do other things in life, you might consider a lazy investment portfolio. So I'm Barbara Friedberg. You could find me at Barbara Friedberg Personal Finance. Thanks so much for watching. See you next time.